in the global economy, and that banks are now better positioned both to meet future credit growth and meet future credit demand and to support economic growth. The domestic economy is seeing domestic rebalancing proceeding, but we do note in this report that some of the pressures on the New Zealand dollar have not been helping that rebalancing. We observe that households and businesses are keeping their own spending low as they attempt to reduce their own debt. And together with the increase in export commodity prices, this is all assisting the current account and external indebtedness to decrease. This overall has been positive for financial stability. But the New Zealand dollar is staying relatively high, and this is reflecting easy monetary conditions internationally and weak economic activity in the major developed countries. If this is sustained, we do see the continued rebalancing of our economy towards the tradable sector becoming increasingly difficult. Emerging Asia is still the main engine of global growth, and that of course is positive for New Zealand. Financial markets have generally become more stable since the European sovereign debt crisis in early this year. But the widespread withdrawal of fiscal stimulus and the debt reduction by households and businesses does continue to pose some risks to the global recovery. In the United States, new quantitative easing measures have been recently announced. This is supporting risk asset markets, but it is also putting pressure on capital inflows and exchange rates in third country economies, and that in itself is problematic for international rebalancing. To take you through the second part of the report, I'd like to hand over to Grant Spencer, Deputy Governor. Thank you, Grant.
Well, with respect to the banks, we think they are in pretty good shape. On the funding side, they've been lengthening their borrowing and increasing more deposits, so that in terms of their stable funding, their actual ratios are in excess of the core funding ratio minimum that we set down in our new policy in April earlier this year. So they're looking pretty comfortable on the funding. And I would note that given the stability of the bank liquidity at present, yesterday we announced that we would be removing the last remaining crisis liquidity facility, and that will be coming off in a couple of weeks. On the asset side of the banks, non-performing loans are plateauing. They're stabilising at around 2%, which isn't that high a level given the recession we've had. And we think that we expect that with the recovery continuing next year, that those non-performing loans will start to come off through 2011. The main risks around bank credit, we think, are probably on house prices and agricultural prices, but we don't see either of those risks as particularly significant at this point. In the non-bank sector, we have seen further failures over the past 6 months, most notably, of course, South Canterbury Finance. But we do think that the remaining firms in that sector have relatively low exposure to property development, and that they're well placed now to consolidate and to provide a basis for a return to growth in that sector. I'd also note the non-banks are coming into compliance with the new prudential regime that we have, our new non-bank regime, which most of that will be in place by December next month, in other words. One important development for us has been the passing on the 7th of September of the Insurance Act. So that now means that the Reserve Bank will be responsible for the prudential supervision of all insurance companies in New Zealand. But this is a regime that will take some time to come into place. We're gearing up for it, and that will be introduced over a 3-year period. Finally, I would just mention Basel III. This is the new initiative from the Basel Committee, which bolsters the capital and liquidity requirements for banks internationally. And we expect that the Basel III proposals actually will be ratified by the G20 meeting in Korea later this week. Those are not strictly necessary for every country to adopt, but we have a generally positive view of the Basel III initiatives, but we'll be looking at them closely in terms of before we actually adopt them within the New Zealand regime.
Good, thank you, Grant. So thanks. We're open for any questions you might have.
Felix Maher with News Talk ZB. Across the road at Parliament, there's been some debate in recent weeks between the politicians on both sides of the House about interventions to bring the currency down. Labor is favouring an intervention, the government's not. What sort of resources are available to the Reserve Bank, and what strategy would you favour?
Well, we've got a well-documented policy which says that we're prepared to do limited intervention under quite unusual circumstances, which is either at the very top or the bottom of the cycle, where an intervention would meet a number of quite stringent tests relating to the unjustifiable nature of an exchange rate given where the economy is, and where in addition we felt that intervention might be practical or opportune in financial markets at any particular time. But we've made the obvious point that there's no way that New Zealand can stand in the market against something which is being driven by the major economies offshore, and that's always been the case. That policy hasn't changed. Beyond that, we don't comment about when we will intervene.
Is the currency at an unjustified level given the state of the economy?
The currency has been going through an unusual time where until about 2 weeks ago it had actually been through 5 months of stability if you look at the trade-weighted index, which is where we tend to look. Of course, individual people are either been benefiting or losing quite significantly from the fact that against the US dollar we've gone very strong, and against the Australian dollar we've gone much weaker. That's been quite an unusual situation where the US and the Australian dollar have moved apart very significantly over that time. Now that's changed a little bit over the last 2 weeks, but that's still very much short-term volatility.
Is the bank contemplating any changes to the conditionality around intervention, and if so, what might those changes be, and would the government need to sign off on them?
No.
On South Canterbury Finance, the former Chief Executive there, Sandy Mayer, in a letter to the government, warned of quite serious financial stability issues if the company was to go under, which it now has, obviously. What's your view on the impacts there now, and are you satisfied that there are sufficient institutions taking up the slack in terms of lending to the rural sector in the South Island?
Well, what we call the non-bank deposit-taking sector has contracted very markedly before and through the crisis. That's also been accompanied by a big fall in demand for finance for the property sector, which is particularly the part that's obviously been most hit. At the minute, we're not hearing of major issues around unfulfilled demand for property sector financing, partly because there isn't much demand at the minute. We expect to see the market replace that gap over time. It may happen in different ways. It may happen more with non-deposit taking financial institutions. We're already hearing of plenty of interest around the place, but that's yet to see how that pans out. That sector has contracted very significantly.
And the rural sector there?
Well, we're not hearing about problems of farmers being unable to access funding. There's been a very big increase in agricultural sector lending over the time. At the minute, most farmers are trying to reduce debt, not increase debt.
What's your primary concern around intervening in the markets to bring the New Zealand dollar down? You've obviously got some concerns about it. Is it about the losses that the bank could sustain if it built up a large stock of foreign currency? Is it about inflation? What are the main concerns?
It's not primarily about the losses that the bank could sustain, but indeed the bank could sustain significant losses if it were to get into a big open FX position. It's broadly a recognition of the fact that what we're seeing in the New Zealand dollar is being driven by a much bigger international move at the minute. So as a broad generalisation, much of the pressure on commodity exporting currencies at the moment is related to quantitative easing in the United States. There's no way a small country can lean against that. You've seen countries with much bigger resources try to do that. Japan, about 6 weeks ago, intervened heavily in the FX markets. They did have an impact on the yen. It lasted about a week, and then it's leached out of the system. Earlier this year, the Swiss National Bank carried out some quite major interventions. They were concerned about the rise in the Swiss franc. Similarly, they had an initial effect. It didn't endure.
Is there an argument, though, that just because of the speed that the dollar has shot up, especially against the US dollar, that the bank should be intervening to give firms some time to adjust, some leeway to adjust?
Well, we don't think that we can have a significant effect against the US dollar where it is driven by, for example, US dollar market weakness. If it's driven by more local factors, then that's a different feature. And we do observe that over the last couple of weeks, the financial markets have taken it into their head to interpret some New Zealand data more strongly than we might otherwise do. We'll also note that, of course, if the New Zealand dollar stays at relatively high levels, that does reduce pressure on monetary policy, and the markets will presumably reach the conclusion that there will be likely less of an increased track in interest rates in New Zealand, which in itself ought to moderate their interest in the exchange.